I think we've probably seen the worst in terms of the deceleration in Chinese growth. Don't forget, if you go back to 2010, growth around that time had got up to a high of 12%. We're now running probably around 6.5%. So we've almost had a halving in growth over the last 6 years. And I think the worst is probably behind us on that front. And when you look at the growth numbers that came out on the weekend just past, yes, there was some softness in industrial production, but interestingly, investment seems to be showing signs of stabilisation. And also, if you look at credit growth over the first couple of months of the year, there's also signs of a pickup there, all of which is consistent with the authorities' stimulus measures starting to have an impact. So I think we've probably seen the worst there. Does it mean growth is about to take off and commodity prices are about to take off? No, it doesn't. And likewise, there are those issues with bad debts, uncertainty about the property market and the share market. Those things are still ahead of us. But I think we've seen the worst in terms of growth.
Tactically, Shane, as we approach the second quarter, where does the balance of risks lie and how should you allocate? Where is the value?
Well, if you're looking for value, it's quite difficult to go past the Chinese shares listed in Hong Kong, the so-called 8-share investable shares trading on forward PEs around 6.5 times. Virtually every sector of that market is trading well below global benchmark levels in terms of a range of valuation measures. So it's not just the banks listed in Hong Kong, it's a lot broader than that. So I think that's where the value is in terms of the Chinese share market, and that's also incredibly attractive from a global perspective. But I guess what we need to see is just more evidence that we've seen the worst in terms of Chinese growth. The Chinese growth is at least bottoming out. And I think once we see that, global investors will become more confident in the China story, and you'll start to see shares recover on a more sustained basis out of that market.
OK, let's talk about risks on the external side, be it black swans or grey swans, a Trump presidency, or even the risk of a Brexit, and the odds seem to have shortened after the Brussels attacks. The market is having a very, very tough job pricing all this in, right, Shane?
It certainly is. It had a tougher job earlier this year. Investors almost fell out of bed as we came into the start of the year. There has been a bit of settling since then. Right now, though, I think with markets, share markets, for example, having risen on average 10, 11% or so from their lows back in February, the markets have got to a point where they're a bit overbought. They've had a huge run up. We're now going to go through a bit of a consolidation. Investors sort of saying, well, let's wait and see what the Fed does. Let's wait and see what happens out of Europe, the uncertainty about Brexit and so on. All those sorts of things I think might give us a bit of a consolidation here. But by and large, I think a lot of the severe risks that investors were starting to worry about earlier this year are now receding. There's a bit more confidence that America is not going to have a recession. Manufacturing sector there, not quite as bad as it was. Likewise, a bit more confidence that China is not going to collapse. So all of those things I think have provided relief. It's just that right now the markets needs to go through a bit of a consolidation, having risen so far over such a short period.